Today, I'll be talking about how private credit and private credit firms are just as important as commercial banks in funding and growing the Nigerian economy. My name is Charles. I'm the founder and CEO of Pivot Point Management. At Pivot Point Management, we are a finance company, and one of our focus areas is SME lending. I speak to businesses and individuals every day, and they complain of not getting funded by their banks. I see it on social media. People complain of not getting funded enough by their banks. The truth is, commercial banks cannot do it alone. If they could, there won't be need for microfinance banks in Africa and Asia. There won't be need for private credit firms in the US and other countries of the world. There won't be need for cooperative societies, credit union, etc. The SME business segment is very significant to the Nigerian economy. Despite this significance, they are the most affected by lack of funding from Nigerian banks. Large corporate organizations usually gets funded by Nigerian banks. Now, let me introduce you to the significance of SMEs in Nigeria. If you look at this first pie chart, you see that 96% of businesses in Nigeria are SMEs. A whopping 96%. SMEs employ 84% of everybody employed in Nigeria. The second pie chart. If you look at the third pie chart, you see that SMEs contributes to 48% of the Nigerian GDP. So if SMEs are that important, why are they not funded enough? This shows the businesses that we can classify as SMEs. Most of the data you find around, nano businesses and micro businesses are included as part of SMEs. So if your turnover is less than 1 billion naira in a year, you're an SME. If your staff strength is less than 200 people, you're an SME. Of course, it can be broken down into nano, micro, small and medium enterprises. But if you are below 1 billion in turnover and you have a staff strength less than 200, that business is an SME. So if SMEs are this significant, if SMEs are this important, why are they not funded enough? And why are private credit firms more suited to serve SMEs? What is private credit? Private credit is any lending source that is not a bank. Any lending source at all that is not a bank. Examples of sources of private credit funds: organizations, pension fund managers, asset managers, insurance companies, any company at all, any organization that is not a bank, we fall under organization. Then we have retail and individual investors, people like you and I, rich people. If they decide to give loans to individuals, that's private credit. Then we have government and supranationals. Governments can decide to give money to an organization that goes, and the money goes into lending. As long as that organization is not a bank, that's private credit. Then for supranationals, supranationals are international organizations such as United Nations, African Union, World Health Organization, World Bank, etc. If they decide to give money to an organization, to a firm, and that money is for lending, it's also private credit. Now, let's talk about classification of private credit. I'll only be talking about this part in blue that says corporate direct lending, as I believe it has the best potential for private credit investors, SMEs, and the Nigerian economy at large because of the relative low risk. What makes the usage of private credit funds corporate direct lending? These are some of the characteristics. They are to healthy businesses. Some of the other private credit options are to distressed businesses. They have low risk because they are to healthy businesses. Also, collaterals are usually taken from borrowers, and proper evaluation and underwriting is done before the loan is disbursed. So why are private credit firms the perfect funding source for SMEs, not commercial banks? And I'll tell you. The first reason: commercial banks have access to lend to the most profitable companies in the country. Private credit firms do not have that access. The commercial banks prefer lending to these most profitable companies because over SMEs, because it's less risky, it's less stressful, and it's more profitable. Imagine that one of the most profitable companies in the country walks up to a commercial bank, takes a loan of 10 billion naira, one customer 10 billion naira. If that commercial bank wants to give 10 billion naira to SMEs at 10 million naira each, they have to give to 1,000 SMEs. That's very stressful for them. Private credit firms do not have access to lend to the most profitable companies in the country. So they have to focus on SMEs. Two, private credit firms, especially corporate direct lending firms, make money solely from lending, while banks have alternatives. Commercial banks make money from FX intermediation, they make money from FX trading, they make money from account maintenance charges, etc. So private credit firms have no other choice than to focus on lending. Three, private credit firms can price their loans high to compensate for the high risk of SME loans. Remember, SME loans are riskier than large corporate loans, but commercial banks cannot do this because the rate at which commercial banks can give out loans is influenced by the central bank of Nigeria. And that's how it is all over the world. The central bank of the country, the regulatory bank of the country, influences the rates at which commercial banks can give out loans. Four, private credit firms are not as regulated as commercial banks. They can do business and lend with all the money they have. The money was gathered with the intent of lending it out. While commercial banks are very regulated, they cannot do business with all the money they have. They have to keep a portion as stipulated by the regulatory body, which is CBN, Central Bank of Nigeria. As of today, commercial banks in Nigeria must keep 50% of every deposit they get with CBN for safekeeping. It is called cash reserve requirements. It varies from time to time, but as of today, it is 50%. So it means commercial banks can only do business with 50% of deposit with them. That's what they can lend to businesses. They are very regulated. There's also capital adequacy ratio. They also have to take provision for every loan they book. They are very regulated. But for private credits, they can go all out and do business with all the funds they have. So if we must grow the Nigerian economy, we need more private credit firms, credible private credit firms all over the country. That's how we can fund SME, which is a significant part of the economy. Private credit is not without risks, and these risks can be mitigated. Some of the ways private credit firms can mitigate risk in Nigeria is by doing proper evaluation before approval of loan and disbursement, getting collateral from the borrower, usually movable assets, putting direct debit mandates on the account of the borrower so that you can recover funds. Then, thorough understanding of the business dynamics and the business needs of your clients, the borrowers. Private credit firms, specifically direct lending firms, is what Nigeria needs to grow this economy.